Welcome to the Broken Pie Chart Podcast, episode 151. I'm your host, Derek Moore, and with me back on the program after a 2-week hiatus is my longtime semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today?
Derek, doing well. Congratulations on passing the 150 mark. I'm jealous I wasn't there for it. I heard it was a thrilling episode. I know. I just, sorry, man. I really wish I could have been there, but I'm here. I feel like maybe prime numbers might be my thing. You know,
I was going to say you've never hit the big round number milestone episodes, but you tend to, you know, if we did a scatter plot, you're sort of right before, right after. So anyway.
Right.
Well, you did miss. I read all 14 pages of the PDF of the Fed minutes. Really, no, I didn't do that, but I did highlight those. If anybody wants to go back and listen to last week's breakdown, what's sort, you know, and last week I kind of, Jay, went into what surprised people. Should the people have been surprised, and like what was the language like about the balance sheet reduction? We'll get to some of that, but I think this week, you know, we've talked before about experts are wrong a lot. You know, people go on CNBC, and a lot of times there's pressure when you go on TV. They say, "Hey, give us your trade or give us your prediction." And you know, some people, that's not necessarily the way most people invest when they go on there. But we were talking and we said, why don't we do a little contrarian corner where, okay, let's go through some trades that are outside the norm, go against the current a little bit. And Jay, I think, you know, we'll get into inflation. How do you fix inflation? Is the Fed really going to raise rates? But why don't we start it with that? So, Jay, what are you thinking contrarian wise? Like if you were going to bet against, and by the way, before we get into this, don't trade off these. This is for entertainment. Really, it should be entertainment purposes.
It's education, a little entertainment, right? It's a little bit of both.
Yeah. So, Jay, why don't you start?
Investment advice, not investment advice at all. But right, so you're right. The theme has been inflation. The theme certainly this year has been the Fed's going to act, you know, sooner than it had to, and they're kind of getting caught off sides. But I think the consensus is wrong on this. I don't, necessarily believe we're going to get 4 rate increases this year, which seems to be, what everybody is saying. I think that's wrong. And I think inflation is probably peaking out here. Right. And so for me, I'm going to take the other side of everybody here and, time to get out of commodities, in my opinion, short commodities, right. Be on the other side of that, be on the other side of materials. I'll exclude oil from that conversation only because I think that oil is based on things other than inflation. So I'm going to take oil out of it. I'm going to say that, dollar gets stronger, commodities drop.
Commodities have definitely risen. And I said to somebody, because the quick thing with if somebody said, hey, I think there's going to be a lot more inflation. Inflation is going to be higher than people think. How would I position a portfolio? And you and I would say, well, let's stay in large cap equities, but just be hedged. And if what you're, normally people diversify because they want to try and use diversification to hedge. We prefer hedging directly. But that aside, a lot of people would go on and say, okay, well, we could buy TIPS bonds. We could short treasuries. We could be long commodities. But I feel like people aren't early in that one. I mean, commodities had a really good, if I just look at, let's say, something like the Invesco has the commodity index tracking fund. And is that the best one to use? I don't know. But, year to date.
What's the ticker on that one, Derek?
DBC is the ticker on that one.
Thank you.
So, their 1 year, I think, was close to 43%. So a 1 year, year. Yeah, it's pretty big.
Yeah, I mean, that's an up and to the right chart, right? It's definitely been, the story, the way people have been trying to play inflation. That's a good point. Yep.
The interesting thing too, by the way, since inception, or let's just use the 10-year. The 10-year average annualized return is negative 1.84. So this has been sort of a widowmaker trade for a while.
Yeah, and the thought for a lot of years was, hey, if the markets are going to be turbulent, use commodities as kind of a derivative or alternative, I should say, an alternative portion of your portfolio. And that has, disappointed people through the sell-off anything that we've seen after '08, right? Markets dropped, so have commodities, right? It didn't really help you in the COVID sell-off, didn't help you in 2018. It didn't help you with, all the kind of market wiggles we had, the taper tantrum in 2013. Commodities just haven't been there for you as an alternative and a diversifying agent. They've, like you said, they have disappointed. They have not generated returns over time. Now, I think this year it's been a little different. I think there was fear of stagflation. And in the stagflation environment, which, by the way, I don't think we're in at all. Like, I'm not suggesting that, right? But a stagflation environment, stocks don't work, bonds don't work, cash doesn't work. In those scenarios, commodities can be a solution. And I think that's why it had such a strong year last year.
That would be the contrarian is, hey, you either don't put commodities, if you're using traditional portfolios, as an inflation hedge, or you actually go out and short it, meaning you sell it and hope to buy it back lower later. And would you include gold in that? Because gold, here's the other crazy thing. If you would have said at the beginning of the year, hey, inflation is going to be up 7% next year, what should I be in? Well, commodities definitely did good, but gold was down just a little over 4% in 21. Like, who would have picked that if you thought inflation was 7%, right?
Yeah, that's everybody's always positioned gold as kind of that inflation hedge. It's just not. It's been a disappointment. I'm looking at a chart at it right now. It's been sideways, right? Let me look at a 5-year chart. Yeah, okay, it's up for over the last 5 years, but from where we were when you started talking about inflation, let's say the middle of 2020, it's flat. It's unchanged. It's been a disappointment in an inflationary environment.
And it's down. I think year to date, it's down 1.5, isn't it?
It is. Yeah, it's down this year so far, but it's early this year. But, from its peak that we saw, and I'm just looking at the gold futures, right? From its peak of about almost $2,100 per ounce, now we're at just shy of just under 1,800, right?
Right.
That's, you're down 10% from the top as you were trying to prepare yourself for this, traditional inflation hedge. It's just not working for that.
So imagine this. Okay. So you imagine you had the total, hey, I'm going to hedge inflation. I think it's going to be high in 2020 or 2021. And you say, okay, I'll short treasuries. I'll buy gold. I'll buy commodities. Okay. Commodities did well. The general basket, gold was down. And, if we take something like IEF, which is the 7 to 10 year iShares US Treasury bond ETF, it's, by the way, year to date, it's down up for obvious reasons. But, last year in 21, you would have made a little over 3%. So again, imagine that. Hey, inflation is going to be 7%. I'm going to short treasuries. I'm going to buy gold. And, you would have been marginally okay with the short treasuries. You would have lost money in gold. Who thought, right?
Right. Yeah. But, well, let's actually, so we've heard kind of my contrarian. Why don't we flip to your contrarian trade, Derek? And I think it'll probably lead to a deeper conversation on this topic still.
Yeah. And this is one that a retail trader probably can't do. The first one, the second one, probably. The easy one is, I shouldn't say the easy one. And it dovetails on what you said, Jay. The Fed is not going to raise as much as everyone thinks they will. They're hearing 4 raises, 3 raises. I don't know. Maybe they'll only do 2. It's a complex trade, but you could do this. The Fed funds futures. So the December Fed funds futures, for example, is pricing in it's right on the line of 3 to 4 rate hikes. And so if you were an adventurous type, and you shouldn't do this at home, but you could short Fed funds futures, it's the futures contract, or you could do a complex options trade like a butterfly on a certain number below or above where the Fed funds future is, which meaning rates go up less. It's really not a practical trade for anybody to do, but that would be my first one. And my second one is short tips, Treasury inflation protected securities. So let me stop there, get your comments, and we can dive into it a little bit.
Yeah. So you're right, Derek. There's obvious. So it sounds like you think there's some Fed raises coming, but not as many that are priced into the market, right? So be on the flip side of where the market is pricing in 3.5, 4 raises for the year, right? Makes sense. The short tips is an interesting one because again, tips are designed, right, to be inflation protected, right? They're designed to, give you some sort of offset. We all know that in a rising rate environment, in an inflationary environment, bonds are going to perform poorly, right? Rates go up, bond values go down. So you'd think, tips are the way to protect yourself. So yeah, maybe expand a little bit why you're against adding tips to the portfolio or even getting bearish tips right now.
So tips still have duration. So let's just real quick, for anyone who doesn't know what a Treasury inflation protected security is, you buy the tips bond, and if inflation goes up, the principal value, so every bond starts, $1,000 principal value, right? Or the par value, it would adjust higher that par value or the principal value by whatever the inflation rate is. And conversely, if you have deflation, you could see a decline in those bonds. And I'll put in the show notes. We did an episode with Marcel Benjamin, our friend over at State Street, who's absolute masterclass in that. I'll put that in the show notes. But the thing with tips bonds is a lot of those are actually trading negative yield to maturity. And what does that mean? It means that all else equal, if you hold that bond, and inflation doesn't go up enough, you're not going to have a really good return. And the other thing is, and I'm trying to keep this simple, Jay, and I'll refer people back to that episode if they want really get into the details on this. Tips bonds have duration. And so as interest rates go higher, tips bonds go lower. Inflation can cause an increase in the market values, but in the near term or before maturity, if interest rates spike, tips bonds have more interest rate risk in some cases than nominal treasuries. And so let me pause there, Jay, and bring you back into this and get your thoughts.
Yeah. So when you say the nominal, the actual value of the security itself will decrease more than the yield is going to pay you, right? And it's because of this duration, because it'll be better to buy it later versus what the price is today, right? So it drops to adjust. And while, I'm taking a look at the TIP, the iShares Trust TIPS ETF. And, this year so far, it's down almost 2%. Now that's just price change, right? I don't think there've been any dividends in it yet, but just price change for it it's down. And you'd say, wait, this is the thing that's supposed to protect me against inflation, and inflation is at a 40-year high. Why is this not thing making money? And it's because of what you just said. The underlying security itself is the thing that is got the risk of has the interest rate risk in it. Derek, you sent out to our investment committee a document that kind of talked about the projected impact on a lot of different fixed income securities with just a simple 1% rise in interest rates, kind of assuming a parallel shift across the whole yield curve. And the tips number on that. So even with tips paying us what they're going to pay us, it looks like a total return of like a negative almost 3% in tips, right? The value themselves will drop about a negative 3% total return after what you're getting paid in the tips is going to be the end result. So again, we could dig into that data a little more, but I don't think you're on the wrong side of this trade, not using tips in a portfolio right now, especially with all of the duration risk associated with those bonds.
Yeah, I mean it's a really contrarian trade. It's running into the building when everyone was running out. But sometimes the most obvious place isn't the right place. And this could be one of those cases.
More often than not, that's the case, right? More often than not. Yeah. Following the herd usually doesn't pay off.
Well, I'll give a little, inside baseball. And back in, I think February, it was probably March, whatever the lowest of the market was, we were on our investment committee call. And we don't make, we're not picking asset classes and things like that, right? We buy the market and we hedge. And that's the way we diversify our risk is by hedging. But I kind of said, hey, if the ultimate contrarian play when the market was really down, if was to throw, half your money in triple C rated junk bonds, because the junkier the better, the spreads widen the most there, and small cap value, and maybe even small cap international value. I mean, two asset classes that just got destroyed. Yeah, and those are the ones that actually came way, way back. I mean, I'm not saying we would have done that, but I'm like, hey, if you really want to put the contrarian trade on, nobody wanted that stuff. Nobody wanted triple C junk bonds or small cap value, especially small cap international. But yeah, I mean, it's more of, it's a little bit of an academic exercise, but yeah. I mean, Jay, the other thing too, we talked about that 1% rise in rates, and you can talk to this a little bit. It just kind of shows that going out 30 years, going out long term using bonds, there's a lot of interest rate risk there as well. And even in the U.S. aggregate, the AGG, right?
Absolutely, right. The aggregate bond index, which has a lot of different assets in it, whether it's asset-backed securities, mortgage-backed securities, treasuries, investment grade, high yield. It's kind of an aggregate of the whole index. The farther out in duration you go, the worse the projected performance is going to be. Now, Derek, you told me the other day. Actually, let me comment on the 30-year for a second. So, this data projects that if interest rates were to go up 1%, the actual price return on your 30-year bond would drop nearly 20%. So think about that. You're getting paid, what's the 30-year these days? Is it 2?
Around 2%. Yeah.
Yeah. So you're getting paid 2% a year to give the government the money. But in 1 year, if rates go up by just 1%, your underlying asset will drop by 20%. So, and let alone if we go up, 2% over the next 2 years, right? At that point, hard to project that you're ever going to get your money back from all of that, right? Like you're locked into this thing and you're holding it for a long time. So, bonds with longer duration right now are just not going to they're just not going to pay you back. The 10-year, similar scenario, right? The price return on the 10-year, the actual value of the bond, of a 10-year bond, should drop about 9%. The price is going to drop 9% with a 1% increase in rates. So again, that's just not so. I mean, I don't think anybody, the crowd believes, and everybody believes, right? The Fed is trying to push rates up, trying to slow down inflation. We'll get to that in a minute. So if you think rates are going to go up, being in any kind of duration in bonds seems like, it's going to be tough. It's going to be tough sledding if that's the path you want to invest in. So Derek, so let's go to the AGG for a minute. What is the kind of duration on the aggregate bond index right now? Around?
Yeah, I think it's, I think it's above 8. And
yeah, I thought it was close to 9. Yep.
Yeah, I think you're right. It's, and I believe it's been higher, but we're in the highest areas it's ever been for sure.
Yeah.
I mean,
yeah.
And
so it's just going to be under pressure, right? The longer the duration, the harder it's going to be able to perform in a rising rate environment. And by the way, this is nothing new, right? This has always been the risk. And when it comes to fixed income, right? That's the thing that always puts that asset class in the most trouble.
This is, of course, JP Morgan's data. This is from the Guide to the Markets, which if you haven't downloaded that and you have a couple hours to kill and you really like the markets, and I'm saying this with a smile on my face because I really like this data. I'll put a link in the show notes to how to get to this. I think individuals can get it. I'm not sure, though, if it's just for institutions, but I'll put the link. And it is interesting, though, that the only things that would be positive by their projections on a total return basis are floating rate loans, U.S. high yield, and it doesn't specify the duration, and convertibles. Convertibles make sense because if equities are helped, well, I shouldn't put words in their mouth, but my thought on that is, okay, if you can convert into the equity and the equity does okay during a rising rate environment, maybe that's
those convertibles will hold their value, right? Yeah,
right. Yep. And it's got, there's sort of an option adjusted duration there and what they can convert in, and those things, because there's a decision point there. But high yield is yeah, I mean, and high yield, because so the market return there was minus 3.8, but then when you build in the yield as well, it brings the projection to 0.4%. Of course, that doesn't include any increase in bankruptcies or anything like that. But I mean, it's sort of part of why, I mean, at least in some of our portfolios, We do use short duration high yield, which is not reflected here. And, in some portfolios, we hedge that as well. But it's got less duration risk. It's got other types of risk, like if bankruptcies continue, the credit situation deteriorates, those types of things. But I did think that was interesting, Jay. Of the three that they're potentially positive, those were the three.
Yeah, like the absolute best here on the total return across, the fixed income market is a 2% return with rates going up 1%, and that's the convertibles, and that's because it's based on the stock price. So I'm going to tell you, it's just a hard asset class to be in. So I'm going to take us off on a little tangent here, Derek. What do we tell clients when they say, all right, so fine, I need income and I can't use really any bonds, right? I mean, if I'm willing to take some short duration high yield risk, fine, that might be positive, but what do I do? How do I generate income? I can't take the risk of a stock market that the equity markets have. Where do you find income?
Well, alternatives. I mean, alternative income, which, I mean, that's the place you go, right?
That's what our solution is, right? So yes, little plug for us, but right, we've been running, premium capturing strategies in the options market, the derivatives markets for a long time, over a decade at this point, right? And you have to start to expand what's available to you. I'm not telling everybody to go out and, short the market using options, but what we are telling you is there's other places within the market that you can generate some regular income that's not tied to interest rates. For us, the solution happens to be, our high probability option strategies. And if people are interested, they should reach out to you, Derek, and ask for more information. Or you could go to the ZEGA Financial website and check it out. But there's plenty of information there. We're not going to quote the prices, but I will tell you that, it is something that is going to perform very different than a fixed income solution for your income slice of your portfolio.
Yeah, thanks for the plug there, Jay. I'll just Derek, derek.moore, MOORE at ZEGAFinancial.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to spell correctly. Jay, the other thing, I was just thinking about this too, and a shameless plug for my book. And if you buy mine, you might as well buy yours, Buy and Hedge. But in my book, Broken Pie Chart, I had a full chapter. I called it Target Date Surprise. And the premise there was if we ever did have a situation where rates were going up materially, and the target date funds, of course, take somebody's age and shift a lot more into fixed income, the closer they are to retirement than in retirement. And the target date surprise was, I don't think people realize how much interest rate risk some of the portfolios have. And I realize a lot of people, that's the option that they choose in their 401ks. And it's probably a good choice for a lot of people. But I throw that out, Jay, because I think the risk is not understood with those products.
Yeah, you think a target date fund is designed to help you based on the, okay, I'm going to retire in 10 years. Let me go with the target date fund that matures in 10 years. But what ends up happening is, it uses modern portfolio theory, which to us is not very modern. It's about 70 years old. It was developed in the 50s to say that, as you're approaching retirement, you should have a larger and larger percentage of your portfolio in bonds for safety. Well, in an environment that we're in right now, that's actually the worst thing that you should do. Right. So from us, right, I am recommending for any client that asks me about their target date funds, take it out now. Right. Put it into something where we can actually define your risk. But right, as it's getting closer and closer to the target, the percentage of bonds increases. And we just talked about, the risks of bonds in your portfolio. And yes, maybe it's not going to have, 30-year treasuries in it, but it's definitely going to have, investment grade, going to have some high yield. It probably will have some, 5-year treasuries in it. And so, those holdings take all kinds of interest rate risk. And while you're trying to get yourself safe in anticipation of a need for the money, you're actually adding risk into the portfolio. So, I have not been recommending those, and I've actually been, guiding people elsewhere in their 401ks to move away from those target date funds.
Yeah, that's a good point. Jay, this takes us to the next topic we want to cover, and that's, well, it actually dovetails on what you said and what I talked about too, with the idea of the Fed raising rates. And there's this thing where, we're in a situation now where there's inflation. It was 7% year over year. And some of the expectations, I think I looked at the Cleveland Fed forecast for January. So we just released in January December's numbers. In February, we get January's numbers. And at least over January, it's, close to year over year. And there's different aspects of the inflation report. Used cars were up. New cars were up. Lodging was up away from home. Different things. I don't know what soup did, Jay. Soup is really small. That somebody always asks me about soup because I mentioned it once. Somebody said, "Hey, we need more soup in the more weight in soup
in the number." Yeah.
Rental cars. There's some distortions in there, and December went up on a month-over-month basis less than October and November. But it's this idea of the Fed has to do something, and I think why I want to open the discussion here is there's fiscal policy, which is where the government decides something or Congress passes a law and they send checks out to people, or they increase unemployment insurance, or they do spending, they do, fiscal policy. And then there's monetary policy. And monetary policy is raising or lowering rates, buying or selling bonds, doing any number of things, the reverse repo market. So, Jay, I'm going to throw it to you. Are we sure that what people want the Fed to do, which is raise rates, would actually curb inflation? What do you think?
Yeah, I'm having trouble connecting the dots if this is supply driven inflation, right? Also known as cost push inflation. So if it's the supply chain, if it's higher wages, if it's higher costs of production that are causing the inflation that we have, I'm having trouble connecting the dots why the Fed raising rates is actually going to adjust this. So let's kind of think through the situation here for a second. I'll explain why I'm, having trouble with seeing that raising rates as a solution, or at least to help reduce inflation. So let's say we're still in the pandemic. Let's say you've been to a pharmacy. Hopefully nobody got COVID the last few weeks. I say that I did. It just seems like it's a nice spike going on in January. So people have been to the drugstore, right? And when you go into a drugstore, the shelves, in my opinion, are bare, right? Like how many different versions of Advil and Aleve used to be on the shelves. That's all gone, right? Even the generics are all gone. And so when you look at that kind of an environment, all the supply has been kind of used up, right? Companies have had good sales because they've gone through the inventory that they've been holding for a long time, and they're trying to resupply, right? So now you're this pharmacy and you've got to resupply. What are you going to do? Well, you got to go buy the inventory to put on the shelves. Well, usually what happens when you're buying inventory is you take a loan, right? You got to borrow for that. That's not cash that you take out. You borrow with the expectation that you're going to eventually be able to turn over your inventory. Well, what happens when rates are higher? Guess what? The cost of borrowing is even higher at that point. So what do? You have to pass that expense on to the consumer. We all know that same drugstore can't get anybody to come to work. So what have they done? They've had to push wages up and hired more people. What does that do? Guess what? That's going to mean the supply, it's going to cost more again. And so, when you think about the things that are driving up the cost, raising rates is, I think, only going to increase costs for actually retail. And we could talk about if you're a company that's, cutting down, looking for lumber, right? Or you're a supplier that's a producer that's, trying to manufacture and keep up with the supply. All of those businesses operate on a loan basis, right? There's always borrowing involved as they're ramping up to meet their sales targets. And so, again, as you're raising rates, I think you're only going to increase costs, and that's going to be passed on to the consumers. And I'll finish this out with something that you probably talked about last week, Derek. The Fed has hinted that, maybe they want to take actions that necessarily don't mean they have to raise rates, but they could still affect the yield curve from flattening, right? They still want to steepen the yield curve a little bit. So, they talked about quantitative tightening. So I think the Fed has a handle on this a little bit. At least they realize that raising rates is not going to solve the inflation problem that we have right now. And so that's where I'm just trying to connect the dots with it going, I don't actually think raising rates is going to be good for the inflation situation. So I'll pause there. I rambled a little bit, Derek. Why don't you poke some holes in that or tell me where you agree?
Well, I think there's a cost of carry for inventory. And I think that's one of the things in your drugstore example. If the owner of that drugstore, and let's imagine it's not a chain, it's a single person, or persons, and it's in a small town, and they say, well, I've got to get a loan to buy the inventory to put on my shelves. And if the loan rates go up, because those are a lot of times are, short duration notes or floating rates, if that cost goes up, wouldn't the cost of those goods also go up? Or would it just reduce how much that the owner of that grocery store or drugstore buys and then starts to trickle down? So Jay, I think you're right. I think borrowing costs have to go up, right?
That's the whole point, right? The whole point of raising rates is to slow down the economy, right? That's what they're trying to do. They're saying, hey, look, we don't want to make cash as available, as cheap as it has been in the past. It may slow down investments in growth. And you'd say, like, why do we want to slow down the market? Well, listen, you got a red hot market and you don't want it to create a lot of debt and you want to protect companies from blowing themselves out, right? It always seems like debt and borrowing is the thing that breaks into large, drawn out recessions. Heck, that was the Great Depression, right? So, we still, those kind of borrowing rates don't exist anymore. But my point being that, that's why a Fed wants to kind of slow things down, because they're worried about when a crash comes, it will be a lot bigger of a crash. So yes, raising rates is designed to cause increased costs in doing business, so businesses actually end up spending less. So, I think that's kind of the nature of the beast here. I was thinking of a way to punch a hole in what I said, and I do think there's some sectors of the market.
I'm going to punch holes in it. Don't worry, but I'm going to agree with you on a lot of points too.
Okay,
all
go
right.
ahead.
Well, I just think it goes back to is we have to start with what type of recession was it? And I'll throw another term in there. There's one economist who didn't call it a recession. He called it the Great Suppression, because barring the shutdowns by the government, and you and I have said before, we don't get into COVID policy. Neither of us are virologists. We did watch many episodes of ER over the years. But right. The idea of would there have even been a recession if the really strong-armed, harsh government full shutdowns didn't happen? I think that's an interesting question to ask. So when those happen, was it a demand problem or was it a supply problem? And I'm starting to be in the camp, or I'm in the camp now, that it is a supply side issue that happened. And when you have a supply side issue, the exact wrong thing to do is to throw money at it. Because it's like, hey, we can't get stuff. And imagine you're outside of a football stadium, not a Giant game, because I think that's kind of like oil going negative. You probably would get New York Giants tickets. You'd have to pay somebody to take them.
I can't even give away my tickets at this point, Derek. Really?
Yeah. But imagine you're at the national championship game and the market price is $300 for a ticket. There's not enough supply, so price has risen. And then all of a sudden you give everyone outside more money. That price is going to go up, but they can't give you more tickets. They're not going to be able to supply more tickets. There's a finite. So maybe it's not the best example, but I think a lot of this was caused by fiscal policy, well-intentioned maybe, but I think that's the issue. And I'm going to agree with you on this. If fiscal policy caused this, why does raising rates do anything to fix the supply side problem? And I think that's where you're right. I think where you could poke holes in it is when you increase the cost of borrowing, you do reduce demand. You can cause a fall in asset prices, and there's a wealth effect that leads to less spending. And I think if you can have a fall in, let's say, the confidence of businesses to order, I think you could reduce demand, which would help supply, but at what cost, Jay? And I think that's the thing. If the Fed makes a policy mistake and they raise rates, and that's not the thing really that would have helped, but it does cause problems. Are you causing a recession when the problem all along is fiscal? I'll stop there though, Jay.
Yep. I think you're right. I'll even give another example that really supports that point, Derek. When rates were cut dramatically in 2020, we saw a housing boom, right? I think there were a couple reasons why we saw a housing boom. I think people realized, like, oh my gosh, I got to get out of this congested city that I live in, and I got to move to a house that is more spaced out. Being in an apartment is not a great place to live. Or maybe you realize that, we're working from home, so I need a bigger house because the kids are doing school and I'm doing work from home. Whatever all the reasons were. I think the first wave of it was due to a drop in interest rates. And, you could do the math. When people buy a house, they do the math on how much they're spending every month, not necessarily the value or the cost of the house, right? When you're using a mortgage, you go, I could spend $3,000 a month. Now that rates dropped from 6% to 3%, I could get a lot more house, or I'm willing to pay more for the house that I want to get. So I think when you raise rates, you'll see a slowdown in the housing market. That's it's almost immediate. And all the subsequent, purchases that come along with the house, right? Nobody buys a house and go, I'm done spending money. Everybody buys a house and goes, well, there's this room I want to change over here, and I'd like to get a new refrigerator, and I don't want to use the previous owner's, washer dryer. I want to get my own stuff there, right? So you saw it in appliances out of the gate in 2020. We talked about this in other podcasts way early on about how it's just harder to get things like appliances. So, when you think about all that, I do think that, rising rates will cause people to spend less money on things like houses and even cars, right? There's the whole car dynamic. We could talk about that. Is it supply? Is it demand? Which one is it? Probably more supply right now due to chip shortages. But, it's one of those things that you can see immediate changes in spending when you raise rates. But when you think about really supply that's driven, I'm with you, Derek. I don't think we're actually fixing the core of the problem by, raising rates. Like you just said, I really liked your example of, hey, there's a finite number of seats in the stadium, but if I go outside and hand everybody $300, guess what? And then maybe now I'll spend $700 for a ticket, where before I was only going to spend $300. So, that kind of dynamic definitely is what's happening in the economy today. I don't think raising rates is actually going to slow that down already. Slow that down.
Well, here's a contrarian. If you raise rates, do you increase the incentives for banks to lend more? I mean, if with rates so low, is that causing banks not to want to lend as much? It is a contrarian take. I mean, normally you think about there's a reduction in credit, availability of credit. And if people can't get credit, obviously they can't go out and buy the inventory, do a bunch of stuff. So I don't know, Jay. I mean, that's a contrarian take. Increasing rates increases banks' willingness to lend, right?
Well, I mean, they've been, scraping together their net interest income for quite some time now, the last couple of years as rates dropped, right? But they will be slow. I think you bring up, I'm going to agree. You bring up a good point. They will be slow to, increase their savings interest rate that they pay you, the saver and depositor, but they will be quick in raising their lending rates. So I think for a period of time, right, they're going to kind of, jump ahead of the curve on this. And I would tell you right now, they're probably not as enthused about lending at rates where they are today, knowing that rates are going to go up, or with their expectation that rates are going to go up. But I do think you could see banks increasing their lending business as you get through 2023, after we've had, X number of, rate changes. So I don't think it's an immediate thing, but I do think it's an interesting point, Derek, that, listen, that's how banks make their money, right? They lend at 5%, but pay 1% out on people that give them money in their deposits. And they make that net interest income. Let's face it, that's the basics of the bank model. So that's why people like the financials right now. It still seems a little early, though, for them to get aggressive on lending.
All right, here's another point. How the heck does the Fed raising rates 100 basis points, 25 basis points do anything to fix the supply chain issue? And I'm going to go back to this because I think we can talk about this for a bit. The Fed is not going to be able to get the ports to operate more quickly directly. We all know that when whether we want to say the Great Suppression or the lockdowns or just people's changes in behaviors, it's still that way today. I mean, people weren't going on vacation, they weren't going to concerts, and so they shifted their spending from experiential, experience-based stuff. And they bought a bunch of stuff from Amazon that was made in Asia or somewhere else and had to be put on a container ship and brought in. And that shift in itself probably caused some issues. But the Fed raising rates is not going to help that. Would you agree, Jay?
Yep, I would totally agree. Right, the change in the spend has definitely been evident over the last 2 years. I love your example of, hey, I'm not going on vacation, I'm not going to concerts, I'm going to spend my money elsewhere. There's only so many streaming services you could buy, right? I'm sure, you get your entertainment in a different way. But you're right, you're spending your money on goods instead of those experiential type dollars being spent. And so it's probably more stuff that's getting delivered. How many people bought exercise equipment? I mean, the reason Peloton went through the roof as a stock is because, instead of me going on vacation, I'm going to buy a Peloton, right? I didn't buy a Peloton, by the way. I probably should have, if you've seen a picture of me lately. But it's one of those things that you're right. The money got shifted. The spend got shifted from, experiential things versus, real products that you're actually buying. And so I think the Fed changing rates doesn't change that at all. That's more of a pandemic dynamic than anything else.
Mikhail Rasner was a guest on a podcast I listened to recently called Words and Numbers. It's an economics podcast, and I think they take a very practical view at the world. And it was an insider's view of the supply chain, and it was kind of a fascinating listen, Jay, in that they asked him about the ports. And you remember, I think there was an announcement by the administration, the Biden administration, the ports in LA, which I think includes LA, Long Beach, San Diego. I think it's like a tri-party thing. And he said, what about how much better will the ports be now that they're open 24 hours? And I think the guest had said, well, they were already open like 22 and a half or something like that. In other words, they're only going to be open an extra hour and a half. So I was kind of surprised by that. And I think I knew that, but I just hearing it that plainly was interesting. And then the guest also went on, and I'll put a link to the show notes for their episode, about there's a lot of issues. I mean, there's no room to put these nobody wants empty containers. They're stacking up. There are now maybe disincentives from being able to, charge extra when the things are the containers are there too long. And the whole idea of, truckers showing up and they need some equipment to put on there, and then there's a lack of that, or nobody will take the empty container they're bringing back. So I say all this to, how does the Fed raising rates a quarter point help any of that? I'm agreeing with you, Jay.
Yeah, I don't know. I can't connect those dots, right? The supply chain. I mean, if you're trying to adjust that, delay that you have in getting containers off the boat and getting them onto a truck, wouldn't you have to increase your spend to make that happen, right? Like we got to bring more truckers in, or we have to buy more or get more chassis, or we got to create more containers, right? All the things that are contributing to the supply chain backlog. Wouldn't that require borrowing and investment, right? And wouldn't that all get more expensive if rates were higher? So, yeah, I mean, thanks for supporting the point. I can't connect the dots how raising rates is actually going to help the physical supply chain backlogs that we have.
I mean, wouldn't you say too, we could do a shutdown? Well, I don't know if doing a shutdown would help the supply, the demand side of the supply chain. You could jack up rates to 10%, but I think it's be careful of the unintended consequences of all these things. And in the end, maybe there has to be more fiscal adjustment. I know the government's not sending out the checks anymore. I think some people have talked about that. But some states are still doing their version of enhanced unemployment or other support. So I don't know how this all
I mean, like
works
rental
out.
assistance is still going on at the federal level, right? I think we talked about that. I have a neighbor that's got rental properties here in Florida, and half of them are being paid by the government, not by his tenants, right? So, you want to lead that to the full employment conversation, maybe a little bit, right? Because, the Fed looks at, one of the things they're supposed to do is, I don't think it's full employment. Like, what's the term that they use? It's not optimal employment. I don't know.
It's maximum employment or
maximum, optimal, or whatever the number is.
Yeah.
Right? But they look at the data and they go, at 3.9% unemployment rate in the US, like that feels like everybody who wants a job is getting a job, right? So, all these job openings that we have, and corporations being forced to pay more in wages. Again, higher wages are a symptom of a cost push / supply driven inflation environment. Is that going to change? Right. So, you talk about the government policies that have created these unintended consequences, and you look at things like employment. I think the Fed will look and say, like, well, we've kind of achieved our goal here, but I don't think we've actually achieved our goal. Right. I think they're going to have to continue to try to help manage that wage inflation. But I don't see how raising rates in this environment is going to reduce wage inflation at all, especially that there's employment is, doing very, very well here.
Well, I mean, and I think you mentioned it when you went on CNBC, one of the things was, let's watch how wages are compared to inflation. And if people's wages are trailing inflation, then at some point there's a price level of goods and services that is too much. And then the consumer has to make decisions. Let's cut this, let's keep that. So I think that's also, obviously, when you raise wages, there's more purchasing power. But Jay, I mean, with inflation this high, consumers' purchasing power has been going down, which is sort of curious how that has not affected things yet. But Jay, don't you think that's something to watch?
Yep, totally. Absolutely. I think and you pointed out the other day, right? Wage inflation wage growth is at a lower rate than the inflation rate, right? That was, so you're right. There, at some point, purchasing power is going to decline.
As far as employment, now the other thing too that I think is increasing prices a little bit is the shift of where people can work. I see it in Arizona. I'm sure you see it in Florida, where people who no longer have to, let's say if you're in LA and you have to drive to, I don't know, Studio City in LA or Westwood to go to work. Now you can be at your home. Why not go to Boise, Idaho? Why not go to Scottsdale, Arizona, where we simply don't have the traffic, don't have as higher taxes and all the other sort of things that California does? I think there's been a shift. But if you have a home in California and you're used to paying, X amount of dollars in taxes, it's not a big, like the prices that we have in Arizona may not seem that high, even though for us, they've appreciated quite a bit. I don't know if you're seeing that in Florida as well, Jay, but I think that's a factor.
Well, yeah, I mean, there's been a migration to Florida, and I don't claim to be an expert on this, right? But I think there's a lot of things, right? Lower taxes, I think, bigger spaces, heck, the weather. Like, sorry, man. Like, I think at some point people just want to be in nicer weather like you and I do. It's no offense to anybody in the cold states. I have a friend from Minnesota, and she loves the snow. She loves a snowy day. She loves a dreary, overcast day. But that's not for everybody. I get that. And so, Derek, I think that migration is interesting to see the change in prices where it's like, my buying power from California can buy a much bigger house. I'm willing to pay a little more for something than, the market would price in Arizona. But it's not a big deal because I'm selling a house here that's worth even more out of California. So I do think that has, again, that led to some of the the housing boom that we've been seeing in this country. Again, raising rates might slow that down a little bit, right? Like pushing rates a little higher. I think that'll be kind of the first thing that we see. And I think rental costs are a big deal with all of this as well, right? That was kind of an unintended consequence of the housing boom. I know two people that were renters, and the people that own their house said, "Hey, I'm selling the house. You got to go find somewhere else to rent," right? Like you got 3 months, you got to get out, right? So and then guess what? Where they go is going to be higher rent, right? So rents have gone up. And, a lot of people don't realize is that, your cost, your shelter costs, whether it's, your home or it's your rental property that you're living in, that is a big piece of personal spending. It's something like 30%. I believe. And so when that moves a little bit, it has a much bigger impact than, say, the cost of a can of corn, right? We'll have hey, corn went from $1.69 to $2.69 a can. Is that breaking the bank? No, it's a huge increase, but it's not breaking the bank. But if your rent goes from $2,000 a month to $2,200 a month, that's a big deal. It's a lot of cans of corn every month that would have to offset that, right? So yeah. I just, one of those things to watch for, Derek, with maybe it'll slow down the, raising rates might slow down that cost, right? A little bit out of the gate.
I've only heard a little bit of talk of this, but there is we talked earlier about the unintended consequences. It hasn't been too much on CNBC, but maybe in other circles, the idea that there should be price controls or there should be rationing or something like that. Price controls are one of those things that seem like they would work, but Jay, what happens when you get a price control? You get people don't want to supply. It's the unintended consequences, right?
Yeah, and you start putting businesses under when they can't actually charge for what it costs them to produce goods, right? A great example is what happened over in the UK earlier or later of 2021, right? I think it was up to like $8 a liter in gas, and they put price controls on it. And a couple companies said, "Hey, we're done. Like we actually can't be a business if you're going to limit the amount we could charge for the gasoline we're purchasing." So anybody who's listening from the UK, love to have comments on that if you experience the same thing, who's listening to the podcast. But it's just one of those things that price controls take the free market pricing out of the mix. And of course, that causes all kinds of other problems.
It's actually how, in roundabout way, we got your health insurance tied to companies. Wasn't it the price? They had wage controls. And so companies, to attract workers, had to offer other things to get around the wage controls. I believe that's how employer-sponsored healthcare worked. But that could be
Don't even get me started on healthcare and inflation on healthcare. Let's not even go there.
By the way, you mentioned, I got to bring this up because I love this example. You mentioned the UK. Do you know one of the best examples of unintended consequences is? Do you know where I'm going with this?
I don't. Go ahead. I'm sure you've told me.
The Cobra effect. Have you ever heard of the Cobra effect?
I have. Why don't you explain it?
So the Cobra effect, you've heard of it though, right? Before I explain it.
Yeah, I've definitely heard of it. Yeah, for sure.
So the Cobra effect was, and I've mentioned before, I've also, from time to time teach economics and finance at some local universities. And we use this as an example of the unintended consequences. And the Cobra effect was, I don't remember the year, but the deal is it's when the British, it was before India was independent. So it would have been, colonial India type deal. But there was a number of cobras in one of the cities in India. And cobras are obviously dangerous. They're venomous. And so they decided that, let's get rid of these cobra snakes and we're going to offer a bounty, or we're going to offer money for anyone who brings in a dead cobra. The idea was we'll incent the population to kill these cobras off, and then, we won't have this issue anymore. Well, what happened though was that people said, well, there's the incentives, and people react to incentives. So they started to essentially breed cobras. They would breed them and then bring them in to get the reward. And what happened though? Well, more snakes were created. And so when the government basically was like, well, wait a second, we want to get cobras off the streets, but people are breeding more cobras so they can make money. We're going to stop this incentive. And then what happened? Everybody let go of their cobras into the streets.
What are they going to do with all the cobras? So they just let them out into the streets.
It was
right?
worse. It was worse than ever. So I'm doing that from memory, Jay. I know there's a lot more details.
I think you nailed it, dude. If anybody Googles the Cobra effect, you'll see exactly what you just said.
Yeah, it's unintended consequences. I think, right. But to tie this back to what we kind of started with, sometimes different actions have unintended consequences, and the fix may not be exactly what the medicine is that's required. How's that, Jay?
There you go. I like a different analogy that you use is, when you're a hammer, all you see is nails, right? Yep. And I think that, and again, we've been going on about the Fed for quite a while here on the podcast, but I think it's, they are limited in the amount of tools that they have. I think they're going to try to be, original in the way that they deal with this, supply-driven inflation. But, when the market is looking at it and go, the Fed can't do too many things. One of those things is raising rates. And I think it's scaring the market a little bit. I haven't really heard anybody have this discussion yet. Maybe we're completely off base, or maybe we're the first ones to do it. But, I'm going to stick with the, it's going to be hard to connect the dots between raising rates and dealing with supply-driven inflation. And, it just may be a large mistake. And I think the biggest risk to this market right now is that the Fed makes a mistake like that and they overcompensate in the wrong way. And we'll see. We'll see where things land.
Jay, you were quoted, I think it was in Barron's or Wall Street Journal, and the idea that what the Fed is trying to do is thread the needle. They're trying to manage the shape of the curve, meaning not have short rates get too close or certainly not above the longer rates. They're trying to keep the economy on track, and they're trying to narrowly pick a point to raise rates to that won't cause a recession or a market meltdown. And those three things are really difficult to do.
Yeah, agreed. And it's, we'll see. Again, I'm a little optimistic from the notes that they don't want to just go blanket raising rates, right? And just, hey, everything's a nail, so I'm going to hit it with my hammer, or I'm a hammer, so all I see is nails, and I'm just going to hammer them. So, by the way, I've just botched that. I think that, I'm optimistic that they realize what we're talking about here, that they're going to have to use different tactics to, by the way, we want rates to go up, right? Higher rates are a symptom of a stronger economy. We have a strong economy. I don't think anybody could argue that. Corporate earnings are the strongest that they've been. So rates should come up, to a level that's higher than where it is today. We know this, right? That's the natural progression of things. That's not a bad thing in the long run. But, forcing it and getting it there by taking the wrong action is the thing that we really want to, keep an eye out for and we just hope that they don't do it in a way that causes a massive disruption in the money flow or causes a massive disruption in how allocations are. And, and also at the same time, helping the American public through employment and getting inflation down. Right? There's a lot of things that they have to consider. I'm glad I'm not a Fed governor. I'll tell you that much.
On a positive side, and I think we referenced it. If not, we were thinking of referencing it. It's the Wilmington Trust put out, kind of their 2022 slide deck, their forecast. And I just want to mention that inventory levels are at low points that their chart goes back, I think, to 97. We just haven't seen. And I think they made the point, restocking potentially could add to growth over the course of 22. By the way, that goes back to supply chain. And the other thing I wanted to mention is that it seems like there's either a high correlation or at least coincidental that inflation seems to mirror the increase or decrease in business supply chain delivery times. So to tie a bow on this before I ask you for who will win the Super Bowl eventually, because why not give more predictions that will probably be wrong? Jay, it seems like, to your point, you need to figure out the supply chain delivery times. And if you can figure that out, maybe you get inflation to come down. It's not necessarily rates, right?
Yeah, somebody in our investment committee said to us, no brainer when we brought this up. Like, yeah, of course, if you could get the supply delivery times down, you're going to see prices coming down because now you don't have to charge more to get stuff onto the shelf. Things are more normalized. The other thing I'll point out about inflation, Derek, is inflation is a rate of change calculation, right? And, the denominator is growing right now on that, right? But, having consecutive years of 5-6% is really, really hard to do. You could get this pop higher and then it'll, my expectation is it'll level out over time. I'm not saying so just realize, right, if inflation goes back down to 2 or 3%, it doesn't mean prices come down. It just means the rate of increase in prices has slowed. And so I think that's something also to remember about inflation. So if you can get the supply chain to work itself out, I think you see a normalization and the rate of change of prices, i.e. inflation, starts to flatten out a little bit. But, it's a math number, right? Whether it's wages or cost to produce things, it's still simple third grade division to come up with a rate of change of inflation. And so just that's something to remember, right? Which is also why I think you and I are, back to our first original contrarian trade, feel like things like the tips probably have overdone themselves and commodities probably have overdone themselves a little bit right now.
So tying a bow on that, are you an Ozark watcher, the TV show on Netflix?
Sure. Got Jason Bateman. Awesome.
That's coming back, right?
Yeah, we're going to get a 4th season.
That's coming back. I mean, he starts out as a financial advisor and winds up. Well, I don't want to ruin it for anybody, but it's got a tangential or quasi relationship to the finance world, I would say. Wouldn't you agree?
Yeah, I mean, he was laundering money for a drug lord, right? And then it all kind of went sideways when his partner was skimming, right? And so he has to find new places to launder money. So he moves from Chicago, I think, to the Ozarks and launches a whole bunch of businesses where he can launder money. It's not the business we're recommending anybody get into, by the way.
No,
but it's fun to watch. It's fun to watch.
Yeah, and Billions is coming back too.
Billions is coming back as well.
Yeah, I was just because we mentioned Succession, and I think we talked about. I mean, you and I love that show, and it's they. I don't want to ruin anything for anybody. If you haven't watched Succession yet on HBO, you should watch that. Give it a chance to breathe and grow because the first half of the seasons are always setting up the last halves, right? And they
the payoff is worth it. The payoff is worth it. Yeah,
but Billions is coming back, but no Axe anymore.
No Axelrod. And I we'll see how, I've watched the previews of it a little bit and, I'm going to watch that show no matter what. I almost feel like it's mandatory viewing if you're in our industry. There's so many market accurate things that go on in that show that it's just kind of fun, right? They actually reference things that happen in real life. I think at one point, right, they talked about, the VIX explosion and how they traded through that. And they talk about performance ratios, all kind of stuff that you and I live every day that maybe not everybody picks up. And then that whole detail on, culture and quote movies and songs and those kinds of things. Always fun for guys our age. But when people ask what show do you watch, that's the first one that I tell people. Got to watch.
Do you remember the one though that I hit pause on the screen and only you and I would do this. And there was that long sort of formula with a lot of square roots and, exponents and stuff. And I looked at it, I'm like, and I sort of wrote it down. I'm like, I don't think this is anything. I think they're trying to do a value at risk, but it's wrong, right?
Yep. And it turned out that the guy actually was wrong on the
That's
board.
Right.
It's when they were trying to liquidate a whole bunch of shares of, I think, a natural gas company that they had some inside information. Of course, they were illegally trading on it. But that's what the hedge fund does in that story. And they were trying to figure out a way to, how do we get out of this thing without, taking the full loss ahead of the market open, right? So,
yeah. All right, real quick, Jay, contrarian pick for who plays in the Super Bowl. I would say Raiders and Buccaneers. the obvious one is the Packers and probably the Chiefs, or but any thoughts there?
Oh, listen, I got to give a shout out to one of our guys here on the investment committee, but I think the Cowboys are going to be a surprise.
Oh, no.
I know, man. You know how much that hurts me to say the Cowboys. Listen, by the way, I hope the Eagles just get smashed in their first game. Just for any Eagle fans out there, I'm sorry. Derek can tell you could stop listening right now if you like the Eagles. You have bad judgment. You should just, give up on the broken pie chart. But it hurts me to say the Cowboys could do well, but I think they've got a chance. I think they've got strong momentum, and that defense is pretty tough. Pretty tough. Dak's got to get his head out of his butt. But besides that, I think they got a chance to surprise people.
Well, they did luck out that the Cardinals aren't playing there, because we seem to always win every time we're at Texas Stadium or whatever that AT&T Stadium as they call it now. But we'll save how to fix the New York Giants for another podcast. We simply would not have enough time. And with that, Jay, Thanks for coming on again, and hopefully you won't wait too long to come back. I'll remind everybody to if Broken Pie Chart and Buy and Hedge are two books that, if you haven't gotten already, they make great. What do they make great? I don't know. President's Day.
It's Valentine's Day. Valentine's Day is coming up. I do think it's give the gift of money to a loved one. I think it makes a lot of sense.
The holiday Martin Luther King Day is Monday, and sadly, by the time you listen to this, you won't have enough time to order it. But yeah, by Valentine's Day, that's a good one. Always a good gift. You realize, and people listening to this, it doesn't matter what holiday is coming up. It's always a good gift. I think we had people giving it at Halloween, although kids would probably throw it back at you. And anyway.
Yes, exactly. Yes,
Jay,
Derek, I'll be back on before the next prime number, which is 157. We're not going to go that long, I promise.
All right, folks, and thanks to you in Belarus, Denmark, Luxembourg. We were pretty high on the charts there during the week, and I say this jokingly. I don't get the best data yet on where that is, but at least people listening on Apple Podcast, we seem to have found a following. No one in Gibraltar yet, but one day, Jay, one day.
You're going to give them a book, right?
I will. Anyone who listens to the podcast and has a Gibraltar address, I think that's the way you say it, I will send a signed book, but sadly, no one yet in that area of the world. All right, Jay, let's leave it there before the three people who are still listening decide not to. And we'll talk to you soon. Thanks, Jay.
Thank you, Derek.